Last week, we put out a video all about house hacking, and the response was amazing. And what we saw was a lot of people want to get into real estate, and it created a lot of questions that people asked because of this video. So if you haven't seen it, go back and watch it. But the reason we're making this video today was based on the interest, and what we're gonna go over is the 5 things that you need to know before you begin real estate investing. So we'll get right into it. Number 1, scared money don't make money. When we started St. Archer, which was a craft brewery that we ended up selling to Miller Coors, when we were going through the process of trying to create it, we hit a bunch of hurdles. And one of them was that we realized we didn't have enough money to start the company that we wanted to start. And so Josh, Paul, and I were kind of trying to figure out what our options were to create this thing. And one of the options was basically bringing on investors. And so me, Josh, and Paul are talking, and Josh basically presents that idea. Hey guys, so we need to build out this production brewery. We don't have the money. What we can do is build a business plan. We can go raise capital and use other people's money to do it. And before I could even respond, Paul goes, "Scared money don't make money. Let's do it." And we always joke about that phrase because of course we remembered that moment forever, but there's a lot of truth in it. And the truth is, when it comes to investing, there is risk. And there's different types of risk that you can take, which will then produce a different type of return or reward. But there's also a different risk that you personally might be comfortable with. So the very first thing you need to figure out is what your risk tolerance is, so that you can match that with the best investing strategy. Now, there's a lot of people that just aren't comfortable with investing. Like I have friends that seriously keep all of their money in a savings account because they're just not comfortable losing anything. Now, for me, that seems like the riskiest thing possible. For them, that's their comfort level. So there's not necessarily a right or wrong, but there is an individual risk tolerance that you need to address. And then once you do, it makes it a lot easier to figure out the best strategy to move forward. Number 2, which perfectly follows number 1, and that's to pick your lane or pick your strategy. Once you know your risk tolerance, you know what strategy you can pick. Now, the cool thing about real estate is there's a ton of ways to make money. There's a lot of different ways to be successful. That also is a big challenge because a lot of times you get in and you run around trying to chase the shiny object or do what's kind of popping at that moment. And then you end up becoming, the phrase, a jack of all trades is a master of none. That's totally at play here. So the second thing you're going to want to do is pick one strategy and niche down on it. One of the ways that you can invest is house flipping. This is like a really, really popular one after all those TV shows popped up. But basically, house flipping can give you the ability to make a lot of money in a very short amount of time. For me personally, I've always stayed away from it, and it was really one reason. And it always felt like a job to me. It was always this idea that you had to have a deal to make money, and the second the deals went away, money no longer came in. So that's kind of the big reason why I stayed away from it. But what I do see people do successfully when it comes to house flipping is they view house flipping as their source of income. So they'll flip homes, they'll make a ton of money, and then they'll take a percentage of that money and put it into real estate investments. So I think if you do it that way, you can be real successful. The second way to invest is in rental properties. And in that, you can buy a property and rent it out as a short-term or long-term rental. What I've always liked about this is once you have them, they could just spit off money. So I was always attracted to this style because it was more long-term and I can count on the money coming in. And then in rental properties, there's a ton of different ways to do it. You can do what we covered last week, which is house hacking or owner-occupied. You could do the burst strategy or a value-add strategy. You can do a syndication. And then even beyond that, you have different property types. You have residential, you have commercial. In commercial, you have a ton of different asset classes. And then you have a ton of different areas that you can invest in. So the list can be really broad. Again, pick one of them, hunker down, go niche, and become the best at it. And then as you build out a portfolio, there's nothing at that time that maybe stops you from going, you know what, I want to add another avenue or another lane into my investment strategy, Or maybe you get to a point where, you've built it as big as you can and then you want to move on. But my point is, stay niche, stay focused on the thing that's going to be your greatest opportunity moving forward. 3, understanding market cycles. And yes, real estate fluctuates in value. It does have cycles. Maybe it's not as consistent as maybe something like the stock market, but values do go up and down in real estate. If you were an investor in 2008, you experienced what a market crash feels like. I was a part of that. It didn't feel good, or I would say it was scary, but when done right, they actually don't have to be detrimental or destructive to your investment. I also have the belief that if you know how to invest correctly, you can invest regardless of the cycles. But we'll go into the 4 cycles. First one is recovery. Second one is expansion. Third one is hypersupply. Fourth one is recession. Recovery is typically when the market's at the bottom. You have occupancy that's probably going to be at its low. You have lease up that's going to be really slow. Demand just isn't very strong. You don't see pretty much any construction during this time. And the biggest or the craziest part about it, when you're in the recovery phase, it feels like the recession phase, which is going to be at the end. Then you have the expansion phase. And this is when the market's kind of swinging up. You have demand coming back. You have GDP levels getting pretty close or back to normal. You have your lease up increasing along with rents. And as this phase starts building out, it starts making more and more sense to start developing again. Then third, you have your hyper supply phase. And this is typically when you see the supply outweigh the demand. And this is typically what developers do. They see opportunity and they build and build and build, and they don't stop building. They keep doing it. And typically what happens is supply becomes too great. And when that happens, it brings the demand down. And when the demand comes down, you start seeing vacancy rise. And then the 4th market cycle is recession. And you have more and more vacancies due to the less demand. You typically see rent growth go completely flat or even negative. And you'll usually see operators offer some type of concession or rent reductions just to get people in. Now, I did say above that I think you can invest in any cycle. And this is my view on how to do so. If you have a long-term view and you stay really disciplined on your underwriting and how you find deals, then when there is a correction, it doesn't mean you're screwed. So when you're looking at a deal, if your outlook is 10 years and you're doing your market study and seeing that what you're investing in will have demand in 10 years, you're not over leveraged, then when a market crash comes in, you sit on the cash flow. There's nothing that forces you to sell. And then you can always wait until the market rebounds and then sell at the ideal time. Now, when the market gets frothy, you really have to stick to your discipline. A lot of people talk about real estate right now being at, this all-time high. In this time, you can't allow your emotion to talk you into deals working. You really have to, make sure you're not using debt to kind of financially engineer your deal. And 2, always remember when you're doing your underwriting that things are going to go wrong. Plan for those things to go wrong and make sure you have a great deal in front of you. Now, everyone always talks about, I'm just going to wait for the market to crash. When the market crashes, I'm going to buy everything at a discount. What they don't tell you is actually how difficult it is to invest in those market corrections. It's really scary. And I think a lot of that is you typically don't know when you're at the bottom, like we said in the recovery phase. And a lot of times it's hard to tell when you're at the top until you've already passed it and you're, looking back in time. So I think it's really good if you can just stay disciplined and you get really good at finding deals, you can be successful through any cycle. 4th, how to find these good deals. Now, when it comes to real estate, you're not investing, or I should say this, when you're investing correctly, you're not doing so on a gut feeling, or somebody's not passing you some insider, trading information. Good deals are based on good math. And when you're underwriting a real estate investment, you can get a pretty good idea of what type of profits the real estate investment's going to produce. On a rental, you can figure out how much income is going to come in, what you're going to pay on your property tax, your insurance, your expenses, which is, your utilities, your maintenance, if you have debt service, and it will ultimately lead you to figuring out what your cash flow from the investment is going to be. Then you can make some assumptions, which would be, maybe what your rent growth is going to be in the future, what future cap rates are going to be, etc. In the last video, we included a link that kind of helped educate you on how you go through this underwriting process, as well as a deal analyzer. It's actually at Bigger Pockets, so we'll make sure to include that link in this video as well. And fifth is financing, or getting creative with your financing. Now, a lot of people get turned off by real estate because they see this 20 or 25% that you need to put down on an already expensive asset class. And I think for a lot of people, it just feels out of reach. So they just basically go, I'll never have the money to invest in real estate, and write it off. Really, really important thing. Always ask yourself how you can do something. In real estate, there's a lot of options if you don't have the 20 or 25% to put down. Last week's video was all about house hacking and how if you live in a property, you can get an owner-occupied loan, which allows you to put, possibly between 0 or 3.5% down. That's huge. You can always bring on partners where they basically supply your down payment and then you finance the remainder through the bank. I get this question a lot, and that is, how do I invest in real estate with no money? Now, you absolutely can do that, and how you do it is you need to learn how to go get deals, learn how to underwrite deals, and learn how to go find them. And once you have them, you actually have two options. A lot of people are wholesaling these deals, so they'll find a deal, get it under contract for a certain price, and then sell it to an investor and take the spread, or you can bring investors in. The thing that you really want to remember in this is rich people or the wealthy, they're always looking for opportunity. So if you can find them opportunity, they will absolutely pay you for it, and you can do it where they'll keep you in the deal and you can take equity in the project that you found them, and then you might have to manage it. But that only happens once you educate yourself so that you know what to do and ultimately can make that investment good for them and yourselves. So I hope this part leaves you with some encouragement that even if you don't have the money, you can start taking the steps to start this right now. Thank you for watching this video. If you enjoyed it and we added value, all we ask is that you hit the like button. And if you want to continue educating yourself so you can hit your investing goals, hit subscribe, follow along in this journey, and we'll see you guys next week.